Okay, well, we're going to get started here. My name is Briant Sikorski. I'm a financial planner and wealth advisor with Stratos Wealth Partners, and I occasionally undertake both in-person and webinars. I do in-person speaking engagements of about 6 or 8 times a year, and then I do another half a dozen or so recordings of webinars, about another half a dozen times of the year. So today we're going to talk about the outlook from LPL Financial Research for the rest of the year for the markets. It's entitled Outlook 2017, Gauging Market Milestones. For anyone that has been invited to this event, you will receive an email after we're completed, and in it will also be a copy of the slides. So if you need any of them, they'll be there for you. You'll also receive in that email a link to go back to this presentation and watch it again if you'd like. I will also copy it and upload it to my YouTube channel probably tomorrow. So probably tomorrow, the next day, if you wanted to review it again, or if you know of somebody who would want to watch it in the future, you can go to my website at BriantSikorski.com and click on the YouTube channel there, a little icon in the upper right-hand corner. So this past year, 2016, was by many measurements, a milestone year. Big changes for the markets, the economy, and most definitely for politics. The S&P 500 corporate earnings turned positive, reversing more than a year of declines. After a one-year kind of a hold, the Federal Reserve raised rates for the second time in the current cycle, and we're seeing this as possibly being the start of a more normalized cycle. Some fears of deflation shifted to the talks of reflation, and oil ended a multi-year decline that saw prices fall from over $110 a barrel in 2011 to a low of just over $26 a barrel in February 2016. And perhaps most dramatically, the American populace rebuked what you might say is the political establishment and chose the nation's first president who has held neither a prior political office nor a high military rank, but instead built his entire career in the private sector. We see this as a continued shifting away from a decades-long trend towards increased globalization, as prefaced by the United Kingdom's referendum vote to leave the European Union. So now as we head into this new year, interest rates have moved relatively dramatically, if you will. Cyclically oriented stocks have reasserted market leadership, and oil prices have found a new footing as several major oil-producing countries agreed to production cuts. So with a likely pickup in the pace of economic growth, we're kind of watching 3 major developments to come forward. One is a smoother path to policy changes. There's been a long complaint, many-year complaints about the log jam or in Congress, but with all 3 branches of federal government now being held by the Republican Party, there should be a smoother path to implement policy changes. Secondly, we're seeing this return of earnings growth. So with the earnings recession ending, we expect mid to high single-digit earnings growth, potentially supported by an accelerated U.S. economy. And thirdly is the Federal Reserve, driven by its dual mandate of keeping inflation low and the economy and employment moving forward. We're looking for them to play a key role this next year. So we're going to take a look at some of these different factors, and then we're going to provide you perhaps a couple of ideas of where you can consider investing. So as we mentioned here, smoother paths to policy changes, returning earnings growth, and a dual mandate dynamic by the Federal Reserve. So this is a little multicolored, I have to say nonetheless, portrayal of what we're going to cover today. We're going to talk a little bit about the economy, where we're anticipating about 2.5% GDP growth with steady consumer spending, improved business investment, and a pro-growth fiscal policy giving the economy a lift. Secondly, in the international market, we're looking for earnings growth to be growing and become actually quite strong overseas, particularly in emerging markets. And the risk to that is the currency and trade policy risks. Within stocks, we're looking at mid-single digit returns with a pickup in earnings growth, stable valuations, and mid to late cycle returns. What they mean by that mid-single or mid to late cycle returns is, as we know, the economy is always in a series of growth, maturity, recession, and then regrowth again, or recovery. And bonds with rates expected to climb, both in terms of the Federal Reserve, the reduction in unemployment and consumer spending and government investment. We're expecting interest rates to rise, and this is going to sharply cut into any potential returns that can be experienced in the bond market, much differently than maybe many bond investors got used to over the last 8 or 10 years. So we're looking at this mid-cycle acceleration, and we're seeing that, number one, pro-growth policies are expected to be enacted in the first half of 2017 by the administration. And these are going to be followed by corporate and personal tax cuts, increased spending on infrastructure and defense, and deregulation. So we're looking at those factors to play into an accelerating economy. Secondly, the boost from fiscal policy is likely to be enacted also by mid-2017 with more business-friendly regulations, real gross domestic product growth of 2.5% or maybe a bit more. We also see a disconnect between the, or a change, if you will, to the disconnect that was previous with the Federal Reserve, where even though the economy was growing from a political perspective, the Fed was continuously being held back from raising interest rates on the fear of slowing that growth. So we've seen now that as we approach this mid-cycle, we expect 2.5% or better GDP growth. We expect 2 and even possibly 3 Fed rate hikes, continued acceleration in inflation, and we expect the economy is going to continue to find a lift from steady consumer spending, improved business investment, and a pro-growth fiscal policy. So we see here the contributing factors that go into the gross domestic product, and we see where the blue shows consumer spending, the yellow shows business investment, and the black shows federal government spending. Well, we expect consumer spending to rather plateau out perhaps a bit, but it's going to be followed by a more robust investment by business and by the commitment of the current administration to invest in infrastructure improvements. So we could see particularly both the business investment and the federal government to move forward or continue to move forward the GDP within the economy. I mentioned there's typically about a mid-year delay from the taking of office to fiscal legislation being passed, and we see here Kennedy, Nixon, Ford, Reagan, Clinton, Bush, and Obama being in office, and the actions that they implemented, from spending increases to tax cuts and spending increases. You can see them all passed between 1 and 11 months into their term, with an average of about 6 months. So some of the things that are on the table right now should be put into action, if you will, maybe in the May, June, July timeframe. We also see that, and what this chart is showing us is that both commodities, including all sorts of goods like oil and other natural resources, but also the labor provided by the service sector can contribute to higher inflation. So we're seeing here how, particularly in late 2016, with the unemployment rate dropping and prices for commodities rising, there is that hesitancy, or there is that paradox between what the Federal Reserve wants to do to control inflation versus what perhaps business wants to do to continue to grow. So there's going to be a little bit of that conflict between the two this year. So this is a bit of a busy to say the least. It looks like what do we call it? Air traffic control from Newark. But these are showing, and this print's kind of small, but it's showing a lot of the different factors that the Federal Reserve looks into when kind of charting the economy. So these are things like unemployment rate, which is the very, very first one, as a percentage of labor force participation rate, part-time employment, long-term unemployed, private payroll, composite health wanted index, hiring plans, etc. So I think maybe many investors oversimplify what the Federal Reserve looks at and perhaps considers only interest rates, current interest rates, and unemployment. But you can see there's a lot of other factors that they take into account when making their decisions on what to do about interest rates. On the international front, again, equally, I think, importance or equally surprising, perhaps, for the political outcome here in the U.S., but the UK's referendum vote to leave the European Union, or Brexit, was completely, I guess, unexpected. So we're seeing a populism, a nationalism. We're seeing an anti-globalization sentiment right now. So that's very interesting. It's very interesting to see how this did occur in the UK, followed by, again, the vote here in the United States. So the European, for those that don't, I'll say no, and I'm not saying I certainly do, it's just written here, but the European Union is a group of 28 countries that have many common policies in areas of trade, agriculture, the environment, and consumer protection. They've stated that their essentials for freedoms are freedom of movement for people, capital, trade, and services. And this is interesting. While most, though not all, of the countries in the European Union use the euro as their currency, these countries thereby being known as the Eurozone, the United Kingdom never adopted the euro, and it continues to use the pound. So this is a really momentous change for them, and it was quite surprising. So on the international front, we're seeing this global balancing act between developed and foreign and emerging markets. While the economic fundamentals have been improving across most regions, the earnings growth itself is going to be played out much more in the emerging market segment. And any type of policy risks are the key things that we need to keep an eye on. And that means, is there any type of policy risk that any country politically employs? Does their policy impact the global economy? We're seeing, a continuation of Chinese debt as a consistent risk factor, and we may have seen some blurbs in the papers about currency wars or currency disagreements between countries in the world, and most recently between the U.S. and China. So definitely something that we've got to keep an eye on. We've seen our own dollar kind of rally here within the last 6 months. So why is that important? Well, depending upon whether your currency is higher or lower than a country with which you're trading, is going to influence the price of your goods to them or the price of their goods to yours. So you would like to have currencies, relatively evenly priced or fairly priced, because if there's a huge differentiation between the two, one party is going to, without a doubt, outsell the other, which can adversely impact the trade balance. And that's what the U.S. had been asserting that China was doing, was devaluing its currency to continue to make its products, particularly in the manufacturing sector, less expensive than those products here in the United States. So from an investing perspective, we're looking, again, overseas, particularly if this currency disagreement can be negotiated. We see the opportunity to invest in emerging markets being very strong right now. They do convey a little more risk to them, but right now, particularly in the last year, as we've seen such improvement in our own economy, the emerging market economies are going to potentially have a better opportunistic return for you right now. So if we turn to stocks, we look at, I love this one, gears are turning, but parts may need grease. So we're looking at mid to high single-digit earnings gains from corporate America in 2017, and this will help to continue to support the nearly 8-year-old bull market in U.S. equities. So that's encouraging that we still see the words bull market being employed today. In addition to earnings growth, we expect those gains to be driven by a pickup in U.S. economic growth, particularly due to fiscal stimulus. Number two, stable valuations as measured by the price-to-earnings ratio. So a stable PE should be in the area of 18 to 19. So the valuation fundamentally just means, on a historical perspective, have stocks have they risen too high? Are they unreasonably highly valued, thereby becoming a bubble to be popped later? Three, an expansion in bank lendings. That is being eased. Some of the risks that we need to be sensitive to are a sharp rise in inflation that leaves the Fed in a position of making large catch-up increases in interest rates. Any type of trade war between countries in the world, particularly with the U.S., and any kind of policy mistake, domestic or foreign, that causes a recession or similar market disruption. So if we look at this next chart, it's kind of interesting. It tells us that in the first year of the 4-year presidential cycle, as this year will be, when the U.S. economy does not enter into a recession, the S&P 500 posts gains 92% of the time with an average return of 9.3%. So if history were to repeat itself from an arithmetic perspective, we could hope for, as we said, mid to high, maybe a 9.3% return in the stock market this year. Again, this is being, mentioned in terms of particularly the return of earnings growth to the economy. I can't tell you how important that is. So I think that is one of the major factors in the optimism that we're seeing here. And that's what this chart shows, is it shows the year-over-year revenue growth and the year-over-year earnings per share growth. So that would lead many to believe that any type of, our earnings recession has ended, and earnings are now returning to corporate America, if you will. We've had about 2 years of decline. We're expecting this earnings growth to continue. And one of the other key factors that has played into this is in the area of the oil prices. If we're going to call it cheap oil or inexpensive energy sources of any kind, without a doubt can make the difference in a company's profit or not. So if energy prices and other commodity or natural resources prices get very, very low, that can, and without them doing anything differently than they're already doing, it can move them into a profitable situation. And if not only that, but in a growing profitable or growing earnings direction. So just a lot of concern, I would say concern there, or sensitivity to where we see oil prices heading, in the near term. I mentioned this concern about valuation, and I guess the only thing that we're trying to tell us here is that there's little relationship between stock valuation and short-term performance. So just because our price-earnings ratio is at 18 as opposed to 15, that doesn't necessarily mean a sharp change in the short-term performance of the stock market. So from an investing perspective, we're looking at the current administration to benefit particular sectors, one being energy, as the administration is likely to be much more positive in the usage and exploration of fossil fuels. Two is financials. We've seen commentaries in the news about relaxing certain financial restrictions and limitations. So financials should be a better performer. Healthcare, particularly with the commentary about the repealing of the Affordable Care Act. Industrials and materials, as the administration has talked about, infrastructure spending. So these are a couple that we want to make sure we have in our portfolio. We also, I would say, in addition to the ones I've just mentioned there, I would also add in technology, which I think we've had a bit of a pessimistic view on technology for a while, which I think will change to be much more positive. And number two is in the area of master limited partnerships, which will very much benefit from an improving economy in its usage of oil and natural gas resources. What this chart's trying to show us is that even though if interest rates do increase, that doesn't necessarily mean a significant negative impact to stock performance. I would say it would have a bigger impact on the return, if you will, of bonds. And I think that's on the next slide here. It's coming up. So just a kind of a summary here about some things to invest in, some sectors that I mentioned here a minute ago. Continued investment in the U.S. and exploring opportunities in the emerging markets. So in the bond market, we're expecting a modest rising rate leading to very, low to at best mid-single-digit bond returns, with rates, any way you look at it, expecting to climb, however slowly. So this is definitively going to take away these, double-digit returns that some fixed income investors have experienced in the past. So this shows how, I guess it tries to convey that, yes, we do expect bonds to be much less robust in their return. Nevertheless, if we look back into history, when we see periods here in the third column over, when the S&P 500 has shown significant negative returns, an average of 11%, nonetheless, during those pullbacks in the stock market, we can see where in all but 1 year, the bond market was still positive. So, the moral of the story is don't completely abandon fixed income as a diversifier. I know one of the things that I see LPL research doing is incorporating more what we would call alternative investments in addition to fixed income, in addition to bonds. And those alternative investments can be things like mutual funds or exchange traded funds, for example, in global real estate, in hedge funds, managed futures, arbitrage, global macro. So we're incorporating, if you will, you might say a third sleeve in the diversification mix, so that we're not exclusively at the mercy of either stocks or bonds. The key factor to muting larger or historical over the last 8 or so 10 years of bond returns is any increase in interest rates. So we can see, if you look, if interest rates kind of stay the way they are as reflected by treasuries, and you see the 0 in the middle, then that would mean that we could expect to see a bond return about 3.1% for the year. Conversely, we go far to the right, and if we see treasury yields go up 3/4 of a point, then the total bond return itself would expect to drop by a little over 1%. What this is showing is the difference or the spread between high yield bonds and those of treasury bonds. And why do we care? Well, treasury bonds are considered to be the ultimate safe investment. They're kind of like a certificate of deposit, a CD. You can, I guess, lose money to inflation per se, but you're never really going to physically lose principal. At the other, if you want to call it somewhat of an end of the spectrum or extreme, would be high yield bonds, and these are bonds of companies that have less than perfect credit quality, and they're also called junk bonds. So we can see back in 2008, particularly 2009, where particularly because of what happened in 2008, I would say, you can see where there was a risk aversion, and as a result, high yield bonds had to pay a much higher rate of interest. So they were paying almost 19% more than 18 to 20% more than what a treasury was paying. And we can see how that has really declined now, where the difference between a junk bond and a treasury is now down about maybe 5 or 6%. A big difference there. A number of people ask me about municipal bonds, and after this election here, fixed income markets adjusted the economic implications of the Trump presidency. So this caused valuations in municipals to become more expensive. So we're expecting, as you can see, almost at the very end, where the difference between 10-year and 30-year municipals have almost become the same. Municipals were kind of going through a little bit of a reevaluation there as to whether they were still as good of an investment as many were advocating them to be. But nonetheless, I think it also shows that, as we see the graph going up, that municipals are becoming more expensive to purchase. So they've kind of had a run for a while, and it's going to be more difficult to get a larger rates of return, just like it is out of any fixed income investments. So we're still continuing to favor intermediate term bonds. So those are bonds that are maturing in maybe 5 to 15 years. And as a diversifier, utilizing investment grade corporate bonds and mortgage-backed securities. Some of the lower quality fixed income bonds will likely be supported by business-friendly policies. So it wouldn't hurt to have a portion of your portfolio in some of these high yield or junk bonds, or they're also called bank loans. It wouldn't hurt to hold some of these in your portfolio, because they still are paying measurably higher yields right now. And as again, another diversifier, I mentioned the alternatives. Master limited partnerships right now are, one non-traditional asset, you might say, that is really poised to deliver strong returns in 2017. So again, master limited partnerships are a unique business formation in the oil and natural gas sector that compels them to disperse profits perhaps more quickly than other investments would. So that would be definitely something to take a look at. So again, we're emphasizing intermediate term bonds, and we're looking at a diversification of fixed income to act as a diversifier between different types of bonds. So what I've conveyed to you are, you've heard me mention things that are relatively short-term in nature. I've mentioned, 6 months from now, 3 months from now, 3 to 6 months from now. But I think it also compels us to take a bit of a strategic view as well, because if we look at kind of a longer-term perspective, we can see that we've had a, by and large, consistent long-term earnings growth, as we see in this chart, representing a 6.1% annual growth. So other than the Great Recession in 2008, 2009, we can see that by and large the growth has been relatively consistent. Number two is we've seen, I'm going to actually skip back here, but we've seen a great deal of technology innovation And from a geopolitical perspective, we've seen a spread worldwide of democracy. So in 1900, only 12% of the world's population lived in democracies. And in 2015, that was estimated to be just a bit over 50%. So why do we care about this? Well, the democracies typically have larger larger private sectors where market forces have much more considerable influence. And they also tend to support institutions that advance prosperity, like transparent legal systems and broad educational opportunities. So a critical mass of mature democracies is likely to continue to provide a strong backdrop for a dynamic response to any economic challenges we might have. So that's good. Secondly, jumping here to the next one, is while valuations of stocks within the S&P 500 are above average relative to history, again, I mentioned that we're seeing an improvement in earnings growth. We're also seeing an improvement in productivity. So those factors are also going to play into the profit margins of companies. So some of the things to keep an eye on are productivity. Do we see continued improvement in productivity? 2, trade policies, and 3, any type of geopolitical tensions. So just kind of those are some of the factors that need to be taken into consideration. So in conclusion, we're looking for kind of a balanced approach between growth, meaning companies whose earnings are advancing or growing faster than their peers, or value, such as stocks of companies whose share price has been maybe artificially pushed down. We see a policy tailwind benefiting small companies in the first half of 2017, and then with this continued earnings growth, reassertion in the second half of 2017 by larger companies. We're favoring cyclical sectors, cyclicals meaning things that we buy because we want to, not because we have to. The ones we have to would be considered consumer staple, the staples sector. And we're still looking at excellent opportunities within the U.S. while keeping an eye on emerging market opportunities overseas. On the bonds, look for us to recommend intermediate term, 5 to 15-year maturities with moderate credit sensitivity. And so what this finally shows as a summation are power up. I love these descriptors they use. Consider activating these investment ideas into your portfolio in 2017. So those would be policy drivers. So an emphasis on small companies or small cap friendly policies will likely be well received early in this year. Cyclical economic growth, reflation may benefit cyclicals. Balanced earnings growth, yield curve may put cyclically oriented value on par with growth. And the U.S., with our supportive economic backdrop, provides good prospects for earnings growth. These are in the stock sector. In the last two lower left here, intermediate term bonds, below benchmark duration may be able to weather a modest rise in rates, and moderate credit sensitivity, valuations richer, but economic growth would be supportive. I like this one too. Power down, investment ideas that may be running out of juice. So we have undiversified, defensive. I like defensive meaning utilities, like utility stocks. Unbalanced, cyclicals versus defensives likely be more important than value versus growth. Some of the developed international countries are probably not going to do as well as, say, emerging markets. And part of that is because of Brexit and this populism, anti-globalism that we're seeing kind of spreading around the world right now. In the bond markets, we're shying away from long, like 30-year maturity bonds, and shying a little bit away from the absolute, investment into high investment grade or high quality, because the yield is just not there. Some of those that may present an opportunity with a supportive environment would be small companies. We see here small caps. Nature and timing of policies are key. So these policies mean things like corporate tax reform, cash repatriation, are a couple of examples. We see here also low odds of recession. We're looking at technology, as I mentioned, technology and healthcare re-emerging with reassurance and direction, taking away policy risks. While the risks have slightly increased in the emerging market sector, their fundamentals are clearly remain quite strong at the moment. Investment grade corporates and this moderate credit risk may offset slightly longer maturities that people are going to grab to try to find additional yield. And bank loans, may provide, again, an alternative for slightly increased yield right now. So with that, I will say thank you very much. You can read these disclosures. These are for general information only and not intended to provide be construed as specific investment advice, and that makes sense because everybody's situation is a little bit different. So if you'd like to have you or somebody would like to have your portfolio reviewed and figure out if you're taking advantage of some of these opportunities that we see in the market, I'd be happy to meet with you or them. So with that, I'll say thank you very much. Briant Sikorski, your financial planner and wealth advisor with Stratos Wealth Partners. When I end this, it will kick out an email to those of you that attended. And for those of you that didn't, you can catch this on my YouTube channel by going to www.briantsikorski.com and click on the little YouTube icon, which will take you right to my channel where you can watch this again later or for the very first time. So with that, I will say thank you very much, and I hope you have a great evening.